Hey everybody, welcome to the No Shill Zone. I'm joined with Ben Cowen, and him and I are back here Monday morning, 11 a.m. Eastern time to get into the charts, get into the data. I know there's a lot of other stuff going on in the world, but him and I, we focus on what we do best to deliver you guys the best alpha we can based on just the charts and just the data. So Ben, how you doing, man? And what's on your mind today, buddy?
Yeah, I'm doing pretty well. Markets are pretty lively again, obviously, in not not the best direction today for the market, but that is kind of what we've talked about for a while. That this brutal part of the market cycle is basically upon us, and what we've talked about sort of relentlessly for months is the idea of sort of Bitcoin kicking off a downtrend, right? And it takes a while for people to sort of believe it because you start with a lower high, and until that pans out, so the question still remains, right? Is it a downtrend or not? But the thing that I really go back to is you're seeing Bitcoin go down, but all Bitcoin pairs are going down more, meaning that alts are going down more than Bitcoin, and the dominance of Bitcoin is up. And Gareth, this is a chart that I think is one of the most important charts in crypto. And I mean, look at this perfect like back
Yeah.
test of the breakout point, back testing the 21-week EMA, and it just keeps on going higher. So what do you think about this move here?
Yeah, I mean, I'm in agreement. In fact, let me show my chart as well. Same general thing, just a little bit of a different take for those people watching in on this. And basically, this is case in point what I've done for 24 years. Early on in my career, not very well, obviously, as I struggled to learn. It's very hard to learn, but we saw the initial move up on the Bitcoin dominance to this high that was basically going back to 2021. It hammered on it a few times in early 2023, broke out, and then guess where the low was? It pulled right back to that. And again, I always refer to this, people need to kind of think about it like, think about Napoleon. He got too far away from his home base. And that's kind of, you could argue, at least the history books tell us that's why he wasn't able to continue his conquest. Or, your kid goes to college and, they don't really leave the nest and not come back. They'll come back for Thanksgiving or Christmas. They come back and then they go out on their own again. And that's exactly what the chart did. I mean, to a perfect, like literally, it's basically to the penny on the dominance retrace before it's now starting to go higher. And this is something you'll see in so many charts. Breaks out, retraces to what I call the scene of the crime, and then it gets its energy and continues on its merry way. So, I think you're right on this. I think alts are going to struggle. I think Bitcoin honestly still has some struggle ahead of it, but it's just that alts will struggle more. And I think that we're starting to see this turn in the labor market too. In fact, I wanted to bring this up. I don't know if you had heard this, but we got a great jobs number on Friday, right? Great jobs number, 336,000, super strong gains. But if you look at the underbelly of it, I was looking and I was seeing that part-time had a monstrous gain. So people getting part-time jobs, and we actually lost full-time jobs. And I also saw a stat over the weekend that said in the last 3 months, we've lost over 600,000 full-time jobs. And so this kind of goes to my point of, is the economy really so strong, or are we starting to weaken?
Yeah, I mean, if you look at job openings, what I think is important is the overall trend, right? I mean, yes, it's true that we got a print that was higher than a lot of what people were expecting, but the other truth is that a lot of these reports have actually been revised down. If you wait a couple of months, right? We've had hot prints in the past, and then 2 months later, oh, revise that by 100K, revise that by 200K, and then it doesn't seem as impressive, but job openings is still trending down, right? It's not certainly not a linear path, but my guess is it ends up being a lower high.
Interesting.
And I looked at, and some of the reasons that it actually went up, I believe, is because we saw government job openings is one of the reasons. I mean, like, look at this move here in government job openings, went from 962,000 back up to 1.05 million. So when that stuff sort of happens, it can also skew things. I
Yeah.
think I believe I was reading about that the private sector, like seasonally adjusted, I believe was down pretty big, if I'm not mistaken. But yeah, I think the thing with the whole recession stuff in the labor market, and I know we've talked about this a lot, is that by the time it's obvious to everyone, right? Risk assets are probably bottoming, right? Like altcoins are probably bottoming once we get to that point where, we're actually in a recession, because it means liquidity is ultimately coming back.
That's right. That's right. And I think one of the things that I know you and I have both talked about, and maybe you could even show, is the inversion of the yield curve and how it's actually slowly getting to the point of being uninverted. And we've, Ben and I have gone on here and kind of clamored to as much as we could to say that the inversion is not what matters. It's the uninversion when it uninverts. So you've got this very close to uninversion occurring. We're not quite there yet. Then you start looking at the underbelly of jobs and job openings, and it is starting to paint a picture that, maybe not by year end, which is less than 3 months away, but probably in 2024, contrary to what Jerome Powell said, where he said a month or two ago, hey, we don't project a recession. I think it's getting more and more clear, especially with rates staying higher for longer, that we'll probably have a recession.
Well, I think a nuance of the Treasury yield curve is that the reason it's been in this uninversion process is not because of a bull steepener where the short end goes down. It's because of a bear steepener where the long end goes up, right? So the economy is having to adjust to higher for longer. And I think if you kind of think about how that propagates, higher for longer means businesses are like, oh, well, I guess the cost of, the cost to borrow will stay higher for longer. And therefore, what do? They cut costs. When they cut costs, that could lead to an economic slowdown. It leads to a recession. And that's when the short end of the curve goes down, because then the Fed is actually forced to pivot, because then we're in a recession. But yeah, you're right. I mean, when you look at Treasury yield spreads, like this is a 3-month and the 10-year yield, or the spread. By the way, I actually increased, I think the last time we were showing this, we only had data on this chart through like early 1980s. We now have sort of increased it to go all the way back to early 1960s. And what's fascinating, Gareth, is in the last few business cycles, the recession occurred after the uninversion, right? If you look at the 1970s, during periods of high inflation, the recession actually occurred before the uninversion. And I think the reason is because the reaction function by the Fed was so much different, right? They just, like imagine if the 10-year goes up again, right? I mean, I don't know. I mean, I think at some point we're going to see the long end top out in the not so distant future, if it hasn't already. But think about how hard that could be if it's not done. And if the short end goes up, because what if the Fed hikes again? I don't really think they will. I don't really think they need to. But I think if the Fed were to hike again, it would probably be seen as a mistake, honestly.
Yeah, I wouldn't even be surprised if people look back. And this is the tricky thing, right? Is that, they're trying to analyze real time, and they're using backward looking data oftentimes. And so, I do give them credit in that it's hard. Well, their job is very, very hard to kind of pinpoint exactly and get that soft landing or no landing. But again, unfortunately, they're human and they're going to make mistakes. And we look back at history, and it hasn't been a great job by the Fed in the past. And, again, I do worry that you have inflation where it is. Let's say we hit a recession next year. How do they come out and print? Do they just lower rates a little bit? But they probably can't come out gangbusters like they have done since 2009 with the printing presses, with inflation still stuck at these higher elevated levels.
Gareth, I think you've said that for 2 years, and I think it's completely right? Like they're not going to be as quick to print as they have been in prior business cycles, and we're seeing that now. Think about what would have happened in prior cycles when we showed any sign of economic weakness. What would happen? Print, right? Today, we're seeing weakness in various parts of the economy. It's not shown up necessarily in the labor market yet, but the labor market's also the last thing to move, right? The labor market is what leads to a Fed pivot. And I think your view has been spot on in that they're not going to be as quick to print this time as they have been before. It doesn't mean that they won't. They probably will pivot. I'm guessing they will pivot at some point in 2024. It's possible they could pivot in 2023 if we get a 1987 style crash, right?
Very true.
But I think the most likely outcome is some type of a pivot in 2024.
Well, and I think we have to recognize that a pivot could be like, I could totally see them, like if the stock market, I think we're down 8% off of our recent highs, give or take. If all of a sudden in a week or two we find ourselves down 15 or 16%, they could throw a mercy cut out there to just stem the bleeding, right? Just to say like, hey guys, we've got you, which will reassure the markets, right? But ultimately, can they cut back to 1% on the Fed funds rate in a short amount of time? There is no way they can do that without generating a massive amount of future inflation. And by the way, we're seeing so many kind of strikes going on. UAW, healthcare workers. We saw obviously some of the other recent ones with increases in salary, and that all is coming through, and that will all lead to people having potentially more money as well to spend. So then you could talk about some of the geopolitical stuff going on, which we're not going to get into. But the question is, does that create any supply disruptions, right? And again, right now it isn't, but there is that possibility as well. So it's an uncharted territory of a market right now, an economic picture, and I think it's one that we have to be on our toes with. And I just mentioned before we started the stream. So I see someone asking what should we buy? I can't tell you guys what you should buy. I can just tell you what I did. And I just used the dip in gold into major technical support right down here to add to my gold positions on Thursday and Friday of last week. So, again, to me, that's a place where it's safer. It's not as volatile as Bitcoin. Bitcoin today, I would just point this out, it is down on the day. So there's a lot of people that argue that Bitcoin is like the digital gold already. It's obviously not, or it would be up with gold today. So it is still somewhat of a risk asset. That's clearly seen by the chart. And so gold is a pure play, right? I mean, inflation is there, fear is there, people run into gold.
Yeah, I think gold oftentimes can sort of dip into a recession, right? And then sort of once all the money printing comes back in the recession, right, then you'll see gold shoot up a lot. I think is what has normally happened. But
yeah. And by the way, I think that's one of the most impressive things about gold for me is that if you look at the bigger picture, like let's go to the monthly chart on gold, since COVID and since essentially rates started to go up significantly. I mean, look at where gold is in the cycle. It's still so close to those all-time highs, yet yields have gone, or the Fed funds rate has basically gone from 0 to 5.5. And that's very, very unusual for gold to be able to withstand those interest rate hikes. And even the dollar has been relatively strong as well.
I think one thing that a lot of the viewer or the audience should be aware of with things like precious metals is that these trends can take a lot longer than the crypto
That's
space.
right.
Right? So like in crypto, if it doesn't happen by next week, people just assume you're wrong, right? With precious metals, these are like decade-long trends of that you want to sort of follow and be a part of, that I think a lot of people can often miss. Gareth, you said something earlier that I also wanted to sort of touch base on, and that's the rate cuts, right? Because when we get these rate cuts that will likely come at some point, and you said like if the Fed throws out like sort of like a mercy cut, like, oh, here's 25 basis points off, stocks don't normally bottom after the first rate cut. And the reason is because the Fed usually don't do enough, right? They sort of do something, the market looks at that and says, well, that's not going to help, and it just keeps going down. So, even if they do throw in a mercy rate cut late this year, early next year, it still might not be the end until they get serious about it.
No, and I think that's 100% right, is that they are very scared, I think, of repeating what we've seen in the 70s and 80s, right? So they're going to be very careful about that. I think they're willing, the thing is, they say they're willing to do a recession. The question is how bad of a recession. And my biggest fear, and I think we've talked about this before, is that we may get into a recession that's kind of like not a great. It's kind of not a great environment, but it's not like a 2008 2009. But it could just last for a really long time because the Fed isn't coming to the rescue. So you essentially have a market that's addicted to free money. It goes into a recession, and maybe they, like we said, throw a mercy cut out there. But if they're not going to drop quickly, then you're not going to get that reflex surge in economic activity. And we could just be kind of stuck in this, stagflation-ish environment I worry about.
I think you're right. I mean, and Powell has said they want to avoid this phase over here, right, where we just kept getting subsequently higher peaks in inflation, and it led to higher highs in the S&P and then lower lows in the S&P. Like, imagine if Twitter existed or people were making videos about markets on YouTube back over here, and like think about like you put on a new high and the bulls say they were right, and then they put on a new low, the bears say they were right, and we just go back and forth for a decade. I mean, people must have been exhausted by the end of the 1970s, like talking about financial markets, because it was I guess it was a trader's paradise, right? Where you basically, the idea is you get bearish at these highs and you get bullish at the lows. But I guess at the time, there's no way you would have known necessarily that it would have taken 10 to 15 years to go in another bull run.
That's
Um,
yeah,
so
so true on that.
I think you're right. I do think the Fed would like to avoid that type of scenario. But I think the issue that we're facing right now is, headline inflation is still between 3 to 4%, and that last 1 to 2% is the hardest to get out. Right, getting back to 2%, that's the hardest to get out. And they've talked a big talk for a long time, and we'll see if they're going to walk the walk. Right, like when it comes time, and the equity market is screaming that it needs help, what are they going to do? Are they going to look the other way and say no? Our mandate is price stability and the labor market, to end maximum employment, or are they going to say, oh, we see the S&P needs help, let's come to the rescue? And I think, as you said, I think it's going to take a bit longer.
How do you think it plays in? Like, so one of the concerns that I have, and I know many people share this, is that, we know how much debt the US has now. It's, what is it, 33.5 trillion. And, if rates stay higher for longer, how does that not bankrupt the US with interest payments that are already at $1 trillion, let's say? And I mean, if we just keep adding debt, right? I mean, this is what concerns me too, is that we're in a cycle where this is we're an expansionary period, yet we're still running deficits and the debt is still going up, up, up. What happens when we get in a recession and tax revenue drops off a cliff? And then, like, where does it end, or can it even end?
Right. Yeah. I mean, well, I think that's one of the fundamentally long bull cases for things like, I mean, for gold, right, and theoretically for things like Bitcoin. Although I think Bitcoin still needs to prove that. But you're right. I mean, a lot of these things. I mean, look at tax receipts; they've just been dropping, right? And again, if you look at, because I just pulled this up because you mentioned it, right? When you look at the year-over-year percentage change of tax receipts, when it's like this, it tends to correspond to a recession.
Right.
So I think, like, eventually they're going to have to pivot, right? Eventually they're going to have to. That seems like it's the only way out of the mess that we're in right now. It's just really a matter of time before I think that happens. So I don't really have a great answer in terms of like long term, the debt to GDP doesn't really look that great, but I would suspect it will usher in a recession in the not so distant future.
And I think that's what that is, as someone in society, that's my biggest concern, is like, okay, well, inflation is where it is. So we know that they can't print too quickly, but then our debt is this, and then that's all this money going in, again, just the debt rising and rising and rising. And it's just like, it seems like it's all coming to a head maybe later this decade. And then again, I saw someone mentioning in the chat box talking about the 100-year cycle. And it is something that I'm concerned about. No doubt about it, is that, does it eventually just cause this epic reset? I don't know if you've ever thought about that. Like, is there a point where,
like,
yeah, like where the dollar, like people, like, let's just say the US and its citizens just finally say enough is enough, and we literally go to kind of a crypto type digital currency that can't be printed, that the government does not have the ability, like maybe it expands by 5% a year, like there's a stated expansionary ability, which would potentially fix this ability for politicians to just spend whenever they want.
Yeah, I mean, I think it's probably one of the bull cases for things like Bitcoin. But I mean, that's Bitcoin. That doesn't mean that all the altcoins are gonna, go with it. And someone the other day, someone said that the narratives in the last cycle were this, and this. I'm like, no, Bitcoin is the narrative. A lot of other things sort of tag along for the ride.
Yeah.
And there is value in those other things, but the truth is that if Bitcoin didn't exist, those other things would have never even been created. And we have to be aware of that. It's kind of like the proof of stake stuff. And I've heard, and I would like to get your opinions on the Ether Bitcoin pair. So if you could maybe pull that up, because I've heard forever that the deflationary aspect of Ether Bitcoin will keep it from dropping, right? The Ether Bitcoin pair, but we're not seeing that, right? I mean, and first of all, we know that in the short term, Ethereum supply has actually returned to being inflationary, and the reason is because no one wants to use crypto when liquidity is drying up. So I'm looking at this Ether Bitcoin chart, and it kind of seems like it's breaking down, like that wedge, that wedge that you could draw from those lows, starting in July. Like, I know people have said to me forever that it's a bullish falling wedge, but last cycle that wedge broke to the downside, and I think there's a chance that it might break to the downside this cycle too.
Yeah. So this is one of the worst charts that you can have, where you had a 3-bar surge down and then you went sideways and basically just kind of digested the drop, because what happens when you digest a drop is you get ready to make the same move again. And notice how it's just slowly falling off a cliff. In general, this should, if you look at past history of this type of pattern, this accelerates. So this is it's a slow kind of drip, and then it falls off the cliff and goes very, very quickly. So I would agree with you. That's a very concerning chart. I would say right now you got to be looking at this pivot low here on the Ether Bitcoin chart at around 0.05 or so as your next target. And then again, the question do we continue to go down? I would also say that, and I'm just looking, I don't look at this chart often, but there's an intriguing trend line here right there. Look at this one, goes back to 2016, pivot low, pivot low, pivot low, pivot low, pivot low. My guess is it probably eventually heads back down there.
Right.
You know, and then that'll be like that. Like that's the longer term trend line, right? That's revisiting that longer term trend.
Yeah, and I've we've talked. I think I've said for a while. I think 0.03 to 0.04 is sort of the target, and that seems to be in agreement with that. And here's another way to look at it. If you look at sort of this trend last cycle, you see the initial breakout point for Ether Bitcoin, kind of like this one, the initial breakout, and then you have sort of a double top distribution phase, But what's interesting is the bottom. Like when it came back down, it sort of came back down to sort of where this first one topped out, right, in that range. So if you look at that, right, and go slightly below that, that puts you between 0.03 to 0.04. So I think that is likely the ultimate target for the Ether Bitcoin pair, 0.03 to 0.04. And then we'll figure out what's what. But I mentioned earlier about the inflationary aspect that has started to take place. One of the reasons you could argue that Ethereum's Bitcoin valuation hasn't dropped as quickly yet has been because it was, we were experiencing, it was deflationary, right? This is the supply, right? The supply was going down. But look at it now, like it's starting to go back up.
Yep,
and the question is like, if you flip this over, so you can see the supply change is negative 273,000, right? But look at it over the last 30 days here. Or sorry, I just missed it. Over the last 30 days, it's up almost 30,000 supply. Right. So what happens if we multiply that by like 6 more months, 7 more months, 8 more months? You're starting to get to the point where the supply might go back to where it previously was. So that, what was a case where people would say, well, you're not considering the tokenomics of it. What if that sort of goes out the window because no one is using it? And you can see right here, right? Currently, like on the last, if you just look at the last like 30 days, there's been 465,000 ETH burned, but 828K issued, right? So, I mean, it might be normalized, right? But yearly, right? I mean, it's not in the last month, but if you were to extrapolate out what's happened over the last 30 days for a year, right? That is what it would look like, and so that means the supply growth annually is 0.3%.
Interesting.
So that I think is a concerning thing. Gareth, I want to ask you really quickly about something. I know we don't have much longer, but and it's going back to the Bitcoin dominance, because I think you're more of a technician than I am. And I'm curious, like if you look at like the fib retracement tool, are you pretty familiar with that?
Yeah, definitely.
So like, correct me if I'm wrong, but like if I take this from this high here and draw this out to these lows, the 618 is at 60%, right? The 618 is 60%. Now, look at it last cycle from this sort of breakdown point here to this low. Where did dominance top out? At the 618.
So wow.
So I do wonder if that 60% target is going to come in here, because that is where the 618, I guess this is called like the golden pocket, right? That 60% level. So, I'm still a believer in that 60% target. It could be slightly different. Like it could be 59, it could be 63. And some people say, well, what about stable coins? I think the stablecoin market is why it doesn't go to 65 or 70%, right? But it still could make it close to 60%. What do you think about this type of like the fib retracement stuff? I don't even know if I'm honestly doing it right.
Love it. I love the fibs. And for those of you out there that kind of you just heard about fibs and trading, it's important to recognize that Fibonacci is something that occurs naturally in nature. If you look at the rings on a tree that's been cut down, there's a sequence there that's Fibonacci, petals on a flower. So I'm a big fan of using things that naturally occur in nature, because if they naturally occur in nature, they probably have some influence over us. And so when I see something like that, Ben, I think that makes a lot of sense. It's honestly a great find.
Do you think that maybe, because I mean, you can kind of see this initial move here, this first move got us back up to the to this level, and then this last move got us up to the 0.382. I almost wonder if the next intermediate target is 56%.
Yeah, and interesting. Just a note here on that is one of the ways you could technically play that is let's say we do go to the 50% retrace. If you wanted to, and again, not financial advice, but you could almost play like that would be if you wanted to play a swing trade on alt, you would buy it probably when Bitcoin hits that next level, with the idea that if it pulls back, you'd assume the alts would perform a little bit better in that period.
Speaking of altcoins, what's going on in the altcoin market right now?
Oh my goodness. Well, I was semi-optimistic on something like a Cardano until the last couple days. It broke out of this little bit of a wedge pattern, and it actually had a really nice move up following that. But again, what we're seeing is it's just getting hammered back down. If you're looking at the bull case, you need to get back above basically 27 cents. These highs right here, if you can't get above that, then you're obviously retesting this low here. If you get above 27 cents, you could run to 29 to 30 cents. But I think I'm in agreement with you. I mean, this is a market that, and this is what, it's some of these altcoins are fantastic in terms of what they do, right? What they enable, but the liquidity is still number one. And so many people don't want to admit that because it's just not sexy. It's like, oh, it takes away all your narratives, right? When it's just like, dude, the Fed is sucking liquidity out. Now we're seeing the stock market starting to go down, which sucks out more liquidity. People get risk adverse even more. It makes it hard for the alts, right? There's just no doubt about it.
Well, I think a lot of people sort of take it personally, and it's not meant to be. It's not, we're not commenting on the fundamentals of it, right? No. We're just saying, guys, look, fundamentals doesn't really matter when liquidity is being drained, right? That's the more important thing. And I've looked at sort of this chart here. This is the ADA Bitcoin chart, right? So this is what ADA Bitcoin looks like on a weekly time frame, and you can see that it sort of fell back into this longer term trend line. But I still think that it's going to likely take this plunge down to 400 sats. And by the way, if you look at this on lower time frames, Gareth, I think that you would say maybe it's that scene of the crime thing, right, where it puts in a low, a higher low, a higher low, breaks down, back and then go down.
That's exactly the scene of the crime play, man, right there, that retrace.
Yeah. So I think that's the issue. And I think we've mentioned this the total 3 minus USDT divided by Bitcoin chart a few times. Mm-hmm. And look at it. Like, I mean, it's fallen again, right? Like it's topping out near the same level that it topped out at over here. And it seems like these altcoins are likely going to go down. So currently it's at 44%. I'm still of the opinion that these alts against Bitcoin are on average going to retrace here another 43 to 44% or so.
Wow. I agree. I think that makes sense. Yeah, I agree 100%. In fact, now I do want to just touch on one thing as we kind of wrap things up here. So I do want to go to the bond market, the dollar, essentially the dollar chart as well. And the reason I think this is important for people to understand, I always love the educational side we bring to this as well, is if you look at, usually we're seeing the 10-year move with the dollar. So if the dollar's up, the 10-year's up. Today, we're not seeing that. We're seeing the dollar slightly positive. The 10-year is actually getting hit pretty hard. And I just want people to understand why. The thought process here is that over the weekend, obviously, we saw the Hamas obviously attack, and then all that stuff's going on there. And then basically what that does is it drives people to safety. And interestingly enough, when people go to safety, they buy bonds, which will drive yields lower. So when people get panicky, they buy bonds, which pushes yields down, thus the 10-year falling. But they also buy the dollar as a safety hedge. In fact, in the last few months, 48% of all transactions were in US dollars. That is a new all-time high. So I know, contrary to what everyone wants to think, is like, oh, the dollar is going away. It's not, no, it's still dominant by crazy amounts. And honestly, the more global geopolitical strife, chances are the dollar will still remain that in the near term here. So again, if you're kind of looking at that and you're saying, wait, usually, if you look at the bigger time frame here, the yields were going up. And if we look at the Dixie, we saw this rally as well, but now we're seeing a little divergence there. So I'm in the camp, by the way, that the dollar has topped here. So this is a major trend line. Look at this trend line, by the way, going back to 2021, basically COVID, or just a year after that COVID, but the low pivot. Look at this trend line and look at what we just hit right there last week. And then if you look at the 10-year, same kind of deal here on the 10-year. Let me bring that up here. The 10-year put in a top and tail last week. as well. And if we go to our monthly, you can see this longer term trend line looks like it's top. So I don't know if you have any views on the dollar or the 10-year here.
I think in the short term, well, so I think we mentioned, right, in 2014, the dollar had a pretty sizable rally, and then it actually got a pullback in mid-October, in fact.
That's right.
So I think in the short term, I would say I agree with that statement for sure. I think I even have the euro chart still pulled up. So we drew this actually last week, right, when we were down here. I said, oh, maybe the euro is gonna come up. I think what I'm not sure about, right, and maybe this is where we differ. I don't know. I'm not sure. I would agree that it's a local top, right? It's a local top. I think it seems like the dollar could certainly be due for a pullback. What I'm not sure of is it a more global macro top from where we break down, for the next like 2 years? And I don't really know what your views on that are, but I think in the short term, the dollar has gone up a lot, and I think the higher for longer aspect of it, a lot of the higher for longer at this point, I think, has been priced in. I just don't know if all of it has been or not. I guess it depends on what the stock market does. I mean, if the stock market kind of stabilizes at 4,300 and starts trending back up into the end of the year, then it might mean the Fed needs to do more.
Yeah,
right?
Absolutely.
I think a lot of it just depends on where equities go, I think.
Yeah, I just want to respond to this exponential knowledge guy. That's the bond market is closed. Gareth has no idea what he's talking about. The divergence. No, you're an idiot, but bro, the futures are open. The bond market is closed today, but the futures are open. And if you look at the chart of the 10-year, you can still see the price action. So nice try, buddy. But next time look in and do your research. All right, sorry, Ben. I just had to.
No, that's fine.
I just had to throw that out, man. So when idiots speak, it's hard not to respond. It's just like, dude.
Yeah, no, I've followed the bond market for a while. I mean, sort of my target for the bond market for basically the last year was like 80 to 85, or for like TLT, like 80 to 85.
Yeah.
And I mean, we've hit that level. I don't know if it's going to go any lower or not, but what I do know is that based on history, the bond market tends to bottom out well before risk assets do. So I'm kind of saying, well, as long as the bond market keeps going lower, I'm not going to assume that altcoins have bottomed, right? And if the bond market puts in a major low and starts trending up, and then if altcoins keep going down, then I become on the lookout for, hey, this could end up, leading us into the final lows in sort of these risk assets. But that's why, that's the primary reason why I follow the bond market.
Nice. Very nice. All right, buddy. I think it's our time. Let's wrap it up here. I do want to say you guys are awesome. Occasionally we get an idiot in the chat, and I apologize for having to air that, but I did think that needed, because I didn't want the false information. More than anything, I think Ben and I strive to give you guys like the honest data and what's going on. And so I do want to correct things when people kind of make misstatements in the live chat here, as we do take a note of that. So on that note, guys, everything below this stream, you can see Ben's information. He is amazing. You guys, he demonstrates it every time in the No Shill Zone. And listen, you go back to our first No Shill Zones, the calls you have made, Ben, have been dead on, pretty much every single one of them. So again, I will just say you are awesome, and it is a pleasure to do this No Shill Zone with you.
Likewise, guys. And I mean, Gareth's views, I mean, he was very vocal back in 2021 about Bitcoin topping out, between 60 and 70K. And a lot of people didn't believe it, right? And, I honestly thought Bitcoin was going to go a bit higher from 69K. But the thing is like, all we're trying to do is tell you our unbiased view of the market, right? That's all we're trying to do. And we're going to keep doing it. So if you're not subscribed to Gareth, make sure you go do so. He's got a great website, inthemoneystocks.com. Links are out in the description below. Follow him, and we will see you guys next week.
Take care, guys. Have a great one.